he's talking to. These are people that found us and became students of ours, and pretty neat stuff. So you can look there. There's Peter from Denver, California. Hello, Peter.
I see Iraq come up.
We got it all over, man. We
That's
got a
cool.
great customer base. There's Carol from California. Carol didn't know anything about the market about, I guess, about 4 years ago, and joined one of our classes, and she's become a real star. She's outstanding. Jim there's been trading for 35 years. He's from California also, and great
Jersey
trader
City.
in his own right. And John there is a former Air Force guy, a buddy of mine out of Florida. New student, Doc there, he's a new one. Morris been with me about, I guess, Morris, what, 15, 17 years a student at DTI? Morris is out of up north where it gets cold, Wisconsin. And anyway, yeah, I saw Jeff at the, I saw Jeff, I went down to the Orlando Money Show and walked around, and I ran into Jeff down there. I've known him for a long time. I've been a customer of his for about 25 plus years. And, it's interesting at DTI. I know Chuck gets one every year from the company, and Adam Mowry and Jonathan, we all get copies of it because, it's got a lot of great stuff in there. The older you get, one of the functions is the older you get, it helps refresh your memory when you go through the year. And so I like it for that reason when I, just remember things. But anyway, let's get started. First of all, folks, just to tell you that my caution yesterday, I think, was warranted. We already took profit on a trade we did yesterday on the QQQ, my pocket put theory. And this market is, as I showed you from the research key yesterday, I thought that since April, we haven't had 2 down weeks in a row. And so next week, and what's really thrown me, I'm glad Jeff's here, because you always learn when you have somebody with his knowledge here. But what's thrown me is how deep we've gone into November being bearish. Typically, this month is very positive, and we should be positive next week. And in fact, there's a trade inside the Almanac by a friend of mine, John McMillan, and we'll talk a little bit about that today, Jeff, if we can, and once we get into it. But my opinion is right now, you got to be careful. The market, anytime you lose 200 S&P points in a 2-hour period, experience tells me to be very cautious and circle your wagon, so to speak, secure your account. I love a stock called NVIDIA, and I got out of it because I saw this coming, and the stock this morning, if you go look at it, it's like 175. It's a screaming buy at some point, just not yet. And imagine owning that stock and not getting out of it. It was what, at 210, 205, it's pulled back to 175. Just to give you an idea, Palantir's another one, Tesla's another one. Stocks that are sort of fighting the trend are Google and Apple. I talked to one of our customers this morning, and I call him the jockey. He's riding that Apple pretty good, day trading it and doing quite great. So he's here. He's been trading about 35, 40 years also. So got a lot of people been around a long time, a lot of new people that are learning about the market. And what I try to do, Jeff, is just tell everybody, listen to everybody and educate yourself, because this is a hard game, being in the market. That's my opinion. So this is Jeffrey, and I'm going to let Jeffrey just take it away. Then I'll have a few questions after you finish your slides. And if anybody has any questions, type it in there. He'll be glad to answer them, I'm sure. Take it away, Jeffrey.
I'll do my best. Hey, thanks, Tom. Did you say that there hasn't been 2 down weeks in the market, or is that 2 down weeks for your system?
No, 2 down weeks in the market since April. If you look at the each week by week, you've had a down week followed by an up week. Even though it might have been a lower opening on Monday, it ended up for the week. Okay, and that's since April.
I think we had a couple of down weeks for NASDAQ in a row recently. I don't know.
I'm looking at the S&P, Jeff.
Yeah. Listen, I appreciate you having me. I appreciate everybody out there. Thanks for coming today. I'm gonna have a bunch of slides up here. I don't know if we gotta get to them all, but I packed it so we had. But I want to thank you for having me. Thanks everyone for taking some time out of their day. The 26th Almanac is out, and our newsletter subscribers have their copy. It's been shipped out for a while, so they're available, and everyone gets one free for a subscription to the newsletter. But I want to get into some of the stuff that's going on now, as well as the seasonal, um, roundup here. Santa Claus Rally, the real Santa Claus Rally invented by my father. But I put out my newsletter last night, and our feeling as the market was reversing and doing all of its craziness. I mean, it's definitely, as you said, a difficult game. Quite emblematic the last several days, how difficult it can be. But all eyes are on the Fed in our book, and I didn't put this in the deck because I don't know. I just didn't. I was just thinking about year-end seasonality stuff, but everyone's talking about, Bitcoin and crypto and AI, overvalued and sentiment. And if you just sort of line up the recent sell-off from the new all-time highs on October 29th, 28th, 27th of the S&P, Dow was a little bit later, with the FOMC meeting on October 29th, it becomes quite clear that the Fed's waffling is the thing that seems to be really behind the market. So with that said, let's just sort of look at the history of the Almanac. We're going to go next slide. Yeah, here's just a little history, 60 years on the street. Some of the places that I get to appear in the media. Here's the original 1968 Stock Traders Almanac on the left side there, the first annual edition, the current one, the 2026, and some of the other books that we put out. I'm not going to get into my Super Boom Outlook and Forecast, which is based on an old cycle that Yale discovered back in '76 for these big moves. I think the AI boom is all part of that. My little book of market cycles, as well as Yale's Don't Sell Stocks on Monday. And now my father, Yale Hirsch, you can sort of just move through the slides here. I want to talk a little bit about some history. My father was a legend, a visionary. He passed away in 2021 at the ripe old age of 98 years old. And he created this book in 1968 was the first edition, came out in 67, and it's been basically on the desks of top money managers, traders right here, and advisors throughout the world for spanning 7 decades. And it's arguably become the most influential book on the street. We've sold over 1.5 million copies. He had this, epiphany to take all of the market's cycles, patterns, indicators, trading strategies, and lay them out in this calendar format so that he could follow a market schedule along with its own. And the fact that we are, 59 years in, 60th edition's coming out next year is a testament to the iconic thinking and work. He invented the Santa Claus Rally, the January barometer, the best 6 months, put the 4-year cycle on Wall Street's map, coined the phrase Octoberphobia, and the term, if Santa Claus should fail to call, bears may come to Broaden Wall. I like to say, forget sell in May, and you got to buy in October and get your portfolio sober. As we test those October lows currently, it's definitely something to reconsider. So you see a picture of Yale here. The old one, folks are telling me I'm starting to look more and more like him as my hairline's receding. But he's done quite a lot, and it's interesting how his birthday's in October, and every year we kind of just look to him around those times. So my philosophy, sort of a takeoff on the old Santiana quote that those who fail to remember the past are condemned to repeat it. I like to think that those who study market history, those who understand market history, are bound to profit from it. We take in our processes, basically for the past 60 years, analyzing, researching, testing every single trend imaginable. We publish those findings annually in the Stock Traders Almanac and update it weekly and monthly in our Almanac Investor newsletter. And we use this knowledge, turn it into wisdom to construct portfolios using cycles, seasonals, and history, as well as technicals and fundamental analysis, market internals and sentiment, monetary policy and geopolitics, as well as current trends in the economy. I have a special offer for people. You can use the DTI there at the end of the promo code if you want to get a sign up for the newsletter. You get a free copy of the Almanac. Comes with the book. You can QR code that, or just go to stocktradersalmanac.com, click on the appropriate link there, and plug in that promo code right there. But just a little look back at where we started with our forecast for this year. We put out an annual forecast every December. The new one will be coming out in about a month, just before Christmas. This one came out December 19th of 2024. I've lined out our initial probabilities. We were kind of shifted towards the best case scenario, with things doing pretty well. As of yesterday's close, the S&P was up about 11.2% on the year still. So again, double digits. We have been looking for a big, another 20% year. What's gone on recently with the selling brings it into question, obviously, but I still think we're best case, base case scenario. And then, we had a pretty impressive, selling May period, worst 6 months period, where bearish seasonality didn't transpire, and that was a bullish indication. That's a takeoff on an old quote from Edson Gould that if the market doesn't go up during a bullish season, it's a sign that there are other forces at play. And when that period ends, those forces may really have their say. So right now, with the market selling during this bullish November period, it's of concern, and we're all watching it. And we got our eyes on the Fed, as Tom has been saying. We're looking for, if this thing can hold some support here. It's kind of critical right now, and that's what we're telling our subscribers. So just a little look back at the old days, the October phobia thing. It's amazing to me how this never gets old. This is from a page from the 1969 Stock Traders Almanac, talking about how October is this big bargain month. It's a bear killer. The host of bear markets have bottomed in October, especially the midterm year. And, there's this sort of annual surge of funds into the markets, driven by institutional behavior, quarterly behavior, as well as individuals. But there's a lot of this sort of seasonal vortex, this seasonal issue, comes from the mutual fund deadline, the October 31st deadline, where managers have to. It's also for 40 Act funds, where managers have to, which includes ETFs and such, have to reconcile their accounting for year-end December distributions to shareholder accounts, and they take the 10 months ending October 31st. The previous year's 10 months, reconcile it with those two with the calendar year, and it causes a lot of churn. And this is what creates that October phobia and the bear killer bargain month. So let's look at just this post-election year pattern. And while this has got yesterday's close in there, and while we've come back through this really super bullish post-election year since 1985. Post-election years have become the best year of the 4-year cycle since 85. This is what has us leaning on the more bullish side. But we've come back through that, though we're still above the two other bullish scenarios here, which is all post-election years going back to 49 in the black line, and our aggregate cycle, which combines all years, the 4-year cycle here, the post-election year, as well as the 5th year of decade, which is very strong. And you see 25 there correlating. So we can find some support here, and the Fed can get out of the naughty column, which maybe we saw a little bit of that this morning from one of the governor's comments. We can have our Santa Claus rally and get the fourth quarter back up again. But again, on notice, just a reminder that November is the beginning of the best 3-month span of the year, where you can see that Dow and S&P up 4.4%, NASDAQ up 6.2%. This is the 3 consecutive months, November, December, January. Also, the beginning of the best 6 months, which is one of our key strategies. And I like to just pause here and point out, and if you look at the sort of line in my logo behind my head, it is the black line. It was my logo idea, to take that 1-year seasonal pattern and make it one with the word Stock Traders Almanac. But going back to 1950, you see that the market doesn't really sell in May and go away. It's kind of sideways, choppy. And I went back to 87 as well because that's when the market really got changed systemically with the circuit breakers and collars that were put in after the 87 crash. So still the same pattern since 88. But a lot of folks will go back and try to refute this and go back to the beginning of time with the Dow back to 1896, or our data is solid back to 1901. But you can see it's kind of a buy in May here. This is back when our economy was driven by agriculture and farming, when a lot of fuel and seed and fertilizer and hiring and borrowing happened, kind of drove the market up from May through September, harvest time. Then the loans come due. So you can see that it's really only happened in the more modern period post World War II. So this is the basic strategy for the switching. We put out our buy and sell signals using MACD. Technical crossover increases the gains in the best 6 months. It used to be about 7.4% for the Dow in the November to April period. It's 8.7 using a simple MACD timing indicator. We use the 817.9 on the buy side, the 1226 on the sell side. Can get kind of technical there, but the combination of a good tactical indicator and another reason, seasonal or fundamental to get into something, is proven quite well. You can see that the worst months have a little loss of minus 0.4, and compounding a $10,000 initial investment in 1950 yields a gain of close to $4 million versus a loss of about 5,000. Now, I just want to pause for a second, and I don't know if anyone knows a gentleman named David Aronson. He put out a book called Evidence-Based Technical Analysis back in '08. It was our best investment book of the year. And he took 6,200 different black box systems and put them through the scientific method, basically disproving the null hypothesis that the results were not the result of chance and did not have predictive power. And they all failed. We asked him to take our best 6 months, simple, by October 31st, sell April 30th versus sell April 30th, buy April 30th, sell October 31st. And he put it through the same paces starting in 87, the first year after it was first published in the Almanac. And he found that unlike all the other 6,200 different systems, this was the only one that was proven to have predictive power and not be the result of chance. So it works. And then just look at the NASDAQ version. It's even better. This goes back to 71 when NASDAQ started, 12.9%. And this is November to June. It's best 8 months. We had a decent sell signal here in mid-July after the MACD crossover happened. Again, minus 4% the worst months versus 13 in the best months. Loss of 5,000 versus a gain of about $3.5 million since 71. So pretty solid stuff. So with that, let's just take a look at some of the year-end sort of seasonal roundup. The Halloween trade and the Thanksgiving market. The Halloween trade is something that's got to be concerned. Usually the end of October to beginning of November, really strong, great turn of the month trade. Didn't happen this year. Was a bit of a red flag for us. Trading the Thanksgiving market. Now this sets up well. This is all in the Almanac. Thanksgiving, I think you said that in the beginning of your remarks, that one of the more bullish weeks of the year. But the great trade here, and we're getting that this week, is to get into the market into weakness the week before Thanksgiving and sell into some Thanksgiving strength for a great short-term trade. We got our seasonal sectors coming in and some undervalued, under the radar stock picks. The small cap feast is the Thanksgiving to Santa Claus rally. We got the free lunch menu of stocks making new 52-week lows. So we pick on Triple Witching Day in December. We put out that list, glean it, cut out any sort of crazy stocks, and it's usually that's the time of year when these dogs sort of outperform the market. The small cap effect, which is kicking in, I'm going to show you a chart of that, and of course the real Santa Claus rally and the January indicator trifecta, the first 5 days, and the January barometer. So let's just look at a little Thanksgiving analysis here. This is something we put out in the newsletter last night. When the market's got double-digit gains as of the Tuesday before Thanksgiving, and this is as of yesterday's close here, the 11.2%, it's pretty bullish for the end of the year average about 2.2% through the Tuesday before to the year end. Year gains are pretty solid. There's a couple of blemishes in here, but some of that big decline we had in 2018, the year was down going into the Thanksgiving. So about 70% of the time, the market's up 25 to 36 from the Tuesday before Thanksgiving to the year end, if we're up double digits on that date. But Santa Claus rally is pretty strong here. We got that in there. Now, this is the last 5 days of the year plus the first two of the new year. It's really an indicator. Just of note that the 5 down years here were followed by flat and negative gains in 24. Solid gains in 24. Forgive me for that. That's the only one that had good gains on there. So then the small cap effect. This is something called, used to be the January effect. But most of the January effect takes place the last 2 weeks of December. This is the Russell 2000 versus the Russell 1000. And you can see 25 here in the orange line with the average going over. We sort of split the year from July to June, so we can see this sort of end of the year stuff in the middle, and small caps start to outperform. And it's starting to pick up here a little bit, and we'll probably get another little pullback. And then this is the mid-December to mid-January is the big move when Russell 2000 outperforms. So this is that setup for the small cap effect, what used to be called the January effect. So then I'm going to talk to you about the Santa Claus rally and the January barometer, invented in 72, came out in the 1973 Stock Traders Almanac. If Santa Claus should fail to call, bears may come to Broaden Wall. January barometer, as the S&P goes in January, so goes the year. A lot of people get confused or use the Santa Claus rally as some sort of trading vehicle. It's really more of an indicator. And you can see here when it doesn't happen, we tend to get flat years, bear markets. I've highlighted some of the little mini bear we had in 2016. The no bear here in 23. The AI super boom ticks off. 25, we had a near bear with the April tariff tumble. Excuse me. So this is the page right out of the 26 Stock Traders Almanac. And I can tell you that this is the first leg of our January indicator trifecta. And it's, not some great trade. 1.3% or 1.5% for the S&P, but if it doesn't happen, that's an issue. The January barometer, just comparing all the other barometers here from the different months, just to show you the efficacy of the January barometer. Only 12 major errors since 1950, 84% accuracy ratio, including 8 flat years, either up or down, 5%, still 73% accurate. And the reason it works is the lame duck amendment to the Constitution, which took Inauguration Day from March 4th to January 20th. It took new Congresses from convening 13 months later, which is why they're called lame ducks, to the January right after they were elected. Puts all this stuff in January, creates the birth of the January barometer, all the political involvement. So what really we find most important or most instructive is the January indicator trifecta. Again, this is a page right out of the Almanac. We stood on Yale's shoulders, combined his Santa Claus rally, the January barometer, with the first 5 days early warning indicator. And when all three are up, S&P 500 is up 90.6% of the time, 29 to 32 years, 17.7% average gain. If any of these are down, the year's results are reduced. So if we get a positive January indicator trifecta, it's pretty much smooth sailing. That was the case we had in 23, which was great. But the years that there are issues, got to watch out. Oftentimes, you'll just get a better buying opportunity later in the year, but sometimes you get a nasty bear market. And then I give you a sneak peek at next year. Again, out of my outlook in the new Almanac, pages 10 and 11. Midterm election years are known as a bottom picker's paradise, another phrase that Yale created. And you can see this weak spot here, the Q2, Q3 period. We're concerned that 26 might be fraught with crisis and bear market action and economic weakness. 10 of the last 16 bear markets bottomed in the midterm year. 2022 is a case in point. So I think after reaching negative territory here in Q2, Q3, we might be able to rally at the outset of what we call the sweet spot of the 4-year cycle, which I'll show you more on in a second. Pushing the year into the black, maybe 4 to 8% is what my current outlook is. We will adjust that with the annual forecast in the newsletter next month. So the sweet spot, a couple of charts off of page 46 in the Almanac, is the fourth quarter of the midterm year, that's next year, and the first two quarters of the pre-election year, which would be 27. Dow and S&P up 19, 20%. NASDAQ up 29.4%. Again, we had that weak spot in 22. You can see there was a little weakness in Q1 of post-election year, which we had this year. And here, this was, when we put out the Almanac, published it back in mid-year, is where we were at the time. And if you just check out the next slide, look, sort of a more bar chart version of it. You can see that weakness we had this year in the Q1 kind of rolled over into early Q2. And then this weak spot, if you remember 22, we had, that bear market that was Q2, Q3 sets up, the great 4-year cycle buy, about 20% Dow and S&P, 30% almost for NASDAQ. And this is the, bottom picker's paradise. And one other look is the 50% gain from the 50% gain from the 26 low to the 27 high. It's actually 46.3%. You can see a lot of annual highs for the pre-election year hitting on December. A lot of them the end of the year. Bunch of Octobers in here. And then for NASDAQ, just 66.6% since 74 from the midterm low to the pre-election year. I don't have a slide on that, but that's the number. And then, as you can see, sector-wise, this is what's in play right now. We've got buys out on correlated ETFs for this in the newsletter. Annual sector buying spree begins in October. We're getting another opportunity to get in there. Again, current selling, definitely a concern. We are watching that. But if we can get find some support here, I think we could, again, achieve some gains, especially if the Fed gets off the schneid and stops toying with the market and is consistent. So if you want to come check us out, I tell you what to buy, when to buy, at what price, not just any random number. We put out buy limits, stop losses. There's you get a free copy of the book, the stock picks, our monthly webinar with members only subscribers, kind of like what Tom's doing here. We open the floor to Q&A. We do like a hour Q&A. So again, if you want to check out, it's for fund managers, advisors, individuals. We think we're the authority on seasonal market performance. Same stuff happens year in, year out. We show you what to do and how to capitalize them. Some of the highlights from understanding market history, producing some gains like these. There's some of the ETF highlights and our couple of stock picks. And then the stock portfolio performance chart. This is just the stocks, not the ETF stuff. Again, up 700 plus versus 380 and 350 for the Russell and the S&P. So come check it out. StockTradersAlmanac.com, QR code, promo code. Happy to take any questions. Hopefully that wasn't too much.
That was great. In fact, they'll go back probably like I'm going to do and just listen to it again. But what we'll do is I got a couple questions. I think it says a lot that you said 60, was it 69 you started or Yale started 69?
Yale started. The first edition was the 68.
68, yeah. But I want people to think about it. So you asked the question, why would somebody that started something back in 1968 still be relevant today? I think he just proved a point that the quality always stays at the top. And I've got a lot of friends, obviously, that get this book, and a lot of people that's heard me talk before have always liked it. And actually I sent Jeff a picture of Linda, my buddy. I saw Linda sent you one also, and Linda Rasky, and I thought, well, I got one too, so I sent it to you. And but this is a book that will help you, I think, navigate. Good read. It's simple. It's straightforward. He brings a lot of concepts that you probably don't hear on an everyday podcast or deal. And experience is worth a lot of money. And you get a whole pack of it right here in the book. But the question I got for you, Jeff, I said, we're entering this season right now. And, the point is, he's talking about divergence. Going back to 2022, I think people here know that we got short early in that year. And probably the primary reason we did is our 3-day algo that we use, and the combination that it was diverging from what we were expecting to see. And sure enough, it was a heck of a year for us when other people were losing their shorts. Not shorts, or losing their longs, I guess. But here's my question, Jeff. Okay, you meet a lot of people. You've been around a long time, and I think that you see people make mistakes that you meet in trading and investing. And what would you say would be some suggestions for people that may be getting started or been in the business for a while, things they ought to do?
Well, I mean, everybody, for me as well as everybody, it's always being emotional. Trading when things are going, against you, or when things are going crazy and you're not prepared. You got to have your stop losses, buy limits, whether they're mental or otherwise, and you got to stick to your system. But checking the emotions at the door, doing your research and entry and exit levels while things are quiet, while you're not trading, and then sticking to it is the biggest thing. Doing your homework, writing things down, but basically checking your emotions at the door. And the other thing is, you got to let your winners ride and sell your losers short. So cut your losses quick and fast, and don't be so greedy and try to take profits when things are going up.
Yeah, I find that greed was, as a young trader years ago, that was a big issue, and I also had to develop that process. So hey, I'm happy at this level, and then I'll go find something else to buy or sell or whatever. But another thing, Jeff, you've seen a lot of a lot of people will poo-poo seasonality. Okay, they'll say that seasonality doesn't work. Well, I'm proof positive it does, and I think a lot of people are that actually in the markets and understand it. And you look for things. It doesn't mean that, as Jeff said, I think that sometimes you get divergence. And when you get divergence, that's the red flag. You go, whoa, this is not supposed to act this way. Okay. So
it becomes an indicator.
Yeah, it's an indicator, in fact. And so when you're thinking about it, I know you've heard that before. How do you sort of answer that question about seasonality?
I mean, as I said, nothing works 100% of the time. I don't work 100% of the time. I do sleep sometimes, It's like,
right.
It's a guide. It's a framework. You correlate it with other things. Just the best 6 month system, where we, use a technical indicator for entries and exits on top of the seasonality. So you want to combine it with something else. You want to use it as a framework and a guide, and keep you alert to the times of the year or the times of the month, day, week, whenever it is, because we get down into that, when the market's got a bias towards upside or downside. And that when it doesn't work, when seasonality doesn't work, like I quoted Edson Gould and my version of it on the bullish side, it's an indication that something else is going on. And that's kind of what I think we're experiencing right here, right now, with the way this market is having some issues. It's not perfect. Nothing is. There's no system that works perfectly. Seasonality is another tool. It's one of the ones we use in conjunction with fundamentals and technicals and other observations. But we wouldn't be around for 59, 60 years if it wasn't helpful to people. So people can poo-poo whatever they want. They don't have to use it. And the fact that they're skeptics sort of keeps it honest. If everyone believed it, then it definitely wouldn't work. Everyone would be doing the same thing.
Exactly. Good point. All right, let's take a couple questions for people. How should you be using the Almanac on a daily, weekly, and monthly basis? Okay, and I know this is an opinion, but if you're somebody out there that subscribes and gets the Almanac, maybe for the first time or second time, how would you tell them to get the most out of it?
Well, initially, you want to get comfortable and familiar with what we're putting in there. There's stuff on each day. I mean, read the intro and see what some of the notations mean, so that you know what you're looking at. Each day, there's a bias for the market. Either it's neutral or bullish or bearish, and you can see those what we call the probability number on each trading day on the calendar side. Um, there is,
Let me
you
stop
know.
you. Explain to them the probability number because I get that question 100% of the time. People, what does that probability number mean?
It means it's the number of times that the market, whichever we're looking at, has been up or down on that particular trading day of the year. It's not a calendar day, it's a trading day. And we count things from front to back and the middle. So we're looking for, the beginnings and ends and middles of things are very important. So it's the last trading day of the month, the first trading day of the month. It's not necessarily the 31st, and this is the whole market probability calendar is in the back of the book. You can see the whole calendar laid out, the most recent 21 years, and then the longer period back to 1950 or 71, depending on the index. And that gives you an idea of what the market's likelihood is on that day. But the beginning of November is a bullish cluster. We didn't get that. So what does that mean? She's not, it doesn't work? No. It means there's other forces that are more powerful. There's something going on here. And that's why we're all cautious right now. So there's also day trading page in the back about the times of the day when the market tends to do its things. That 230 bottom tends to be persistent despite the HFT and algo trading. There's the days of the month. Each month has its own little personality. December can be a little weaker in the beginning with tax loss selling. Early August is also weak in the beginning with people vacationing and stuff like that. So that, and just sort of open to the page where we're at right now, pick this week and read what's relevant, and just start from there. So you can, start at the beginning and get yourself familiar with how it works, or just open up to this week and see where we're at in the market, and then look at some of the stuff in the back, how to keep track of your work, take notes, write things down, there's a line in the back that those, if you don't profit from your investment mistakes, somebody else will.
David asked a great question. He says, have you ever specifically analyzed the effects of the two major Jewish holidays?
Yep. Yeah, we
All
have
right.
it. Yeah, sell Rosh Hashanah, buy Yom Kippur, sell Passover. It lines up perfectly with the best months. It is something I usually put out on the blog every year and remind everybody about it. Most definitely. And it's most interesting that those holidays tend to fall right around that real turbulent time of the year in September and October. So it's no coincidence.
That's a great question. Other questions anybody has would be glad to cover. I saw something about GAN, but it went
Yeah, I can roll back through here and answer a couple. The GAN question, I don't use GAN specifically, but we do incorporate other technical analysis in the work. So let's see. I'm not sure if that was the best move I just made. I popped it out. Let's see. Jewish holidays, GAN. Without knowing how November 25 will end, do you think that AI is potentially being used to manipulate the market opposite of historical trends? No, I think AI is the part of the super boom equation, and everyone's using it for everything, and it's what's going to rally the market to much higher heights once this shakeout is over. Almanac is a hard copy. I think there's some digital available out there, but it's really meant to be on your desk, in your hand, so you can write stuff down. And we make it so that you can carry it around pretty easily.
Yeah, I got mine. I keep it right here handy because, like I said, it's almost like a history book for you to refresh your memory about certain times and things in the market. And I find it very useful. And obviously, I do being a long-time subscriber of your service and everything, so it's pretty good. And another question. Here's you see something else I missed or something?
Somebody just said old school.
Yeah, you got that right.
I love
Uh,
it.
but we focus a lot, week by week here at DTI, and we have our own software that keeps up with the market 24 hours. I'm an old futures trader, so getting into what you do. But the idea is that I typically will tell people Mondays are days to watch. And I've done that for years because I find that once you watch a market, you sort of, with experience anyway, you sort of get a feel for it for that week. But I know that there's a trade that I don't think I've ever used it, Jeff, in all these years. But you enter on a Tuesday and I guess hold it for a month or so on the Russell. That's from Macmillan, right? Okay.
Uh-huh.
Can you explain that or what you think of it or what's?
What trade is that on a Tuesday?
Yeah, you enter Tuesday before Thanksgiving.
Yes,
And
yes, that's Larry McMillan. Yeah, we that and you hang on all the way through end of the Santa Claus rally, second trading day of January.
yeah, so
It should be setting up pretty well this year with the sell-off.
yeah, it really should. I was wanting to point that out because I saw it in there and I wanted to ask you about it because I can you imagine that I've never taken that trade my whole 25 years. I've never taken that particular trade, maybe other type trades in that area, but I thought, oh, that's a unique thing I picked up,
Yeah, Larry's got some good trades. He and I are friends as well. So
Yeah, that's something we're going to look at, folks, next week when we come back. But I wanted to bring Jeffrey here today, and I think it's perfect timing. And if you do, subscribe or get his book, just type in, did you enjoy what he did today? And if you did, maybe we'll bring him back again, maybe in January or something.
We can keep it real specific instead of general. Talk about what's going on right on live.
Right. Yeah, absolutely. But I know that there's Shoba says, absolutely, please come back, bring him back. Okay, that's what we want to see.
There's a couple of options questions, which I find interesting.
All right, well, answering then.
One of the things about options that we look at, and it's a feature in the Almanac and what we put out in the newsletter is triple witching being very important. And the follow-up is somebody asked about zero-day options. I think they have affected the market. They've sort of flattened things out a bit. I think it's impacted the put-call ratio readings quite a bit, which used to be a great sentiment indicator. So yeah, there's a lot of new wrinkles out there that are impacted, just like ETFs and all the leverage stuff. But options, I still find the triple witching. When stock options, index options, and futures all expire at the end of the month, despite the 0-day expiration stuff, it's still important. And you can see triple witching, especially the week after, being really horrible after end of March and June, and much better, and then September also, and really strong in December. So it's definitely worth keeping an eye on those expiration dates, especially around triple witching, the quarterly ones. Oh my God, a whole bunch of new messages as I was talking.
Yeah.
Oh, thank you guys. Very kind. All right. Thanks, Tom. 24-hour trading. Yeah, I don't think it's as it's changed things. It definitely makes it harder to pick a closing price for doing our analysis, especially with Bitcoin. But
yeah, interesting thing. Speaking of 24-hour trade, I'm a 24-hour trader, obviously with my commodity background and futures and then the stocks. But one of the interesting things, and I think people are going to discover it, is that at 8 o'clock at night, for stocks, where futures open at 6 o'clock the previous night Eastern time, stocks now they're using the set day at 8 o'clock at night, and I had our software programmer program it in there. Very interesting to watch that 8 o'clock opening and then compare it to the cash opening at 9:30. So it's something that I think more people will find out in years to come. You got to follow the money, and so the money settlement for stock brokerages or whatever. I think it's 7:45 now for stocks. And so it starts a new day for, the day trade portion. Another thing, Jeff, I don't know if you heard about this, but they're talking about doing away with the $25,000 requirement for day trading and going down to 2,000.
Wow.
And the financial services industry guy has committed to get that removed. And so if that happens, that's going to bring a lot of people into the trading industry, I think, because a lot of people, that's the stupidest rule. I was talking to Tom Sosnoff about this years ago, and about the stupidest rule ever invented was this day trade rule for stocks and options, because you can't, you use up your 3 in the 5-day pattern, you can't get out without penalizing yourself or taking a loss or being stuck, and waiting for the time. So hopefully they'll get that straight. But it's been a great presentation. What we ought to do, Jonathan, is cut it off here as we go into the, some of our stuff. And that way we got a good, pristine tape that we can use again, and cut the recording, and, we'll make it happen.